We talk about the latest data that we're going to get tomorrow. Bloomberg consensus estimates right now at about 8.1% on that headline number, and a reacceleration, believe it or not, in the core rate to 6.5%. What would shock you tomorrow in those numbers?
Well, what we're looking for through the stack is surprises coming from some of the more volatile components like used car prices or food prices. The stability, though, should come in the shelter component, the rents and owner's equivalent rent. So that alone should keep inflation high and keep the Fed worried about whether they've done enough.
Overall, when will those start to ebb, Michael? Because inherently we know that shelter takes about a year to work its way through the system.
We estimate it's about 6 to 9 months, but yeah, there's a pretty decent lag between private measures of rent inflation and where it shows up in the CPI. So there's definitely that lag. We do think we're pretty close to the peak, if not already there. So the number that we'll get tomorrow will be quite strong, but we think we'll start to come off in the months ahead. The number tomorrow, though, probably won't influence the Fed's next decision at its early November meeting because it'll still be relatively strong. It won't sway enough, even if it misses, to move the Fed. But it might start to influence their decision, say, at their December meeting and beyond. So we're starting to see signs across the globe of softening inflation pressures. The dollar strength certainly plays into that. But it's not yet showing up in the CPI.
Many are taking a reprieve that it's starting to show up in break-evens, which are 2.5% instead of 4-5%. Dan Chung, though, over at Alger today, told me that the market is wrong, break-evens are wrong. What do you think?
We do think they're wrong, but to the opposite side. So very short end forward break-even. So essentially the market's pricing for next year's inflation is still close to 3%. We think that doesn't represent the balance of risks. We think there's a risk that inflation slows more dramatically than that. 3% is still certainly in the cards, given the uncertainty, but the market should be priced for a more balanced risk outlook. Now, as we look much further out the curve, though, we don't think the market is priced for enough concern about inflation staying high. So if we look at measures such as five-year, that's actually pricing for the Fed to miss its target on a more structural basis, even though investors are quite concerned about deglobalization, energy transition, or labor bargaining power pushing up inflation from a structural perspective. So we do think the market's wrong, but in a different way.
Okay, so how low do you see inflation coming back down next year?
So our inflation forecast, our baseline forecast for next year is right around 2.5%. So not much lower than where the market's priced, but there's risks that it could come in even lower when we think about things like, again, the move in the dollar, lower gasoline prices, lower shipping costs, commodity prices have rolled over pretty significantly. So there's a whole host of reasons to think that inflation might slow more dramatically next year, but also there's reasons to worry, and that's why the Fed will continue to raise rates into the end of the year.